Hello, and welcome back to Peninsula of Paradise, the podcast where Florida living meets smart homeownership, real world lending strategies, and financial peace of mind. And Happy New Year. I'm your host, John W. Tanner, a Florida licensed real estate broker, mortgage broker, and former certified residential appraiser. And I'm someone who spent decades inside the real estate valuation and mortgage finance industry right here in the Sunshine State. Today's episode is an important one, and honestly, it's one I wish more homeowners heard before they sign loan documents. Because Florida is different. Florida law affects your mortgage, your equity, your taxes, your refinancing options, and even what lenders can and can't do if something goes wrong. So today's episode is called Florida Law and Your Loan: What Every Homeowner Needs to Know. Now, even though I have a law degree, this is not to be construed as legal advice, but it is practical, experience based education that every Florida homeowner should understand. Let's get into it. Florida real estate doesn't operate like New York or California or even Texas. Here are a few reasons why. Florida is a judicial foreclosure state. Florida has one of the strongest homestead protections in the country. Property taxes, insurance, and HOA laws are very Florida specific, and lending guidelines are often influenced by state level risk factors like hurricanes, flood zones, and condo regulations. This means your loan structure, refinance options, and even equity access are directly tied to Florida law, not just federal lending rules. And yet most homeowners never hear this explained to them. Let's talk about Florida homestead law, one of the most misunderstood, yet one of the most powerful assets in homeowner protections. Florida's homestead law impacts your loan in three major ways. Number one, protection from forced sale. Your primary residence is largely protected from most creditors. That matters when lenders assess your risk, loan terms, and refinance structures. Number two, restrictions on mortgaging the property. In Florida, you generally cannot mortgage your homestead unless the loan is used to purchase, refinance, or improve the property. And both spouses have to sign the mortgage documents, even if only one of them is going to be on the title. This is why lenders are very careful with cash out refinances, with home equity lines of credit, and with business purpose loans that are tied to a homestead. And number three, property tax benefits. Homestead exemption caps how much your taxable value can increase each year. That directly affects your principal, interest, taxes, insurance, and association fees, which is your combined payment, especially escrow taxes. The bottom line is this: homestead status is a loan planning tool, not just a tax benefit. Florida is a judicial foreclosure state, meaning that lenders must go through the court system to foreclose on a property. That process can take months or even years. Why does that matter to you as a borrower? Because lenders price risk into interest rates, loan approval standards, cash out limits, and credit overlays. It's one reason Florida borrowers sometimes see stricter documentation requirements, more conservative appraisals, and additional reserve requirements, because it's so hard for a lender to foreclose on a property. Understanding this helps you prepare instead of being surprised by the lengthy process that you have to go through when you're applying for a home loan. Now let's talk about valuation. It is one of my favorite topics. Florida appraisals are heavily influenced by wind mitigation features, roof age and type, flood zones, condo association financials, and insurance availability. Two homes with the same square footage can have very different loan outcomes based on these factors. This affects your loan to value ratios, whether mortgage insurance is required, and whether a refinance will even work. And in Florida, insurance issues can kill a loan faster than credit. If you live in a condo or a homeowners association, listen closely. Florida law now places heavier scrutiny on condo reserves, structural inspections, and deferred maintenance. After recent legislative changes, many condo buildings no longer qualify for certain loan programs. This can impact purchases, refinances, and cash out loans. Even if you're a financially strong candidate for a loan, the building itself can block the loan. That's why understanding Florida specific condo law is critical before you apply. Here's the final takeaway. Smart Florida homeowners plan their refinances around the homestead rules. They understand insurance and appraisal risk. They avoid over leveraging equity without strategy. They coordinate lenders, realtors, and legal professionals, and they treat home equity like a financial asset and not an ATM. Your home is not just where you live in Florida, it's often your largest protected financial instrument. If today's episode helped you clarify how Florida law can impact your mortgage options, then please do me a favor. Follow the show, share this episode with another Florida homeowner, and remember, informed homeowners make better financial decisions. If you'd like to know your true equity position, or if you want professional guidance on which option is right for you, then reach out to me directly at colemantanner.com or at 904-310-4270. I would be glad to discuss your options when it comes to refinancing or purchase transactions with you and connect you with a preferred lending partner to give you a pre-approval. I'd like to help you unlock your home's equity position wisely and ensure that you're making prudent financial decisions. So when we do talk, I'll run a few different scenarios for you that fits your criteria to ensure that you can make a well-informed, educated decision. This is Peninsula of Paradise, where Florida living meets smart money. I'm John W. Tanner. Thanks for watching, and I'll see you inside of the next episode. Bye for now.